now that the Fed is actually in the business of raising interest rates, where you're going to see that are on variable rate debts and credit cards most notably. Those tend to follow pretty quickly. They'll shadow every move that the Fed makes this year and next, and they typically move higher within 30 to 60 days afterwards. Mortgage rates move well in advance of the Fed, and we have seen a substantial, unprecedented increase in mortgage rates since the beginning of the year. We've seen the fastest run-up in mortgage rates and one of the largest run-ups in mortgage rates in history. Mortgage rates up nearly 3 full percentage points in the last 10 months in anticipation of the Fed raising interest rates. And that had the same impact on affordability for a would-be home buyer as would a 25% price increase. Savings rates are moving higher, but you have to look in the right place. A lot of banks are sitting on a pile of deposits, and so they're not passing along meaningful increases. Instead, look at online banks, smaller community banks, and credit unions. That's where you're seeing more intense competition for savings and certificates of deposit. A lot of those banks are leapfrogging each other week in, week out as interest rates go up, and we expect that's going to pick up momentum in the months ahead. That being said, interest rates are still well below the rate of inflation. It's going to be a long journey. We need to see interest rates go up quite a bit, and we need to see inflation come way down before it turns the tables completely in favor of savers.